Great. Hi, everybody. It's 2 o'clock. Very pleased this afternoon to be joined by Steve Farkas from BlackRock. Steve, I was just looking at the name of the company while we were sitting in the waiting room and thinking this is a really good value presentation because you've got BlackRock, world's largest fund manager, talking about US equities, the world's largest stock market, combined with sustainability and income. So I think we can conclude that this is a pretty good value presentation for all our clients. And talking about our clients in some recent polling, you'll be pleased to hear that Kepler clients are generally pretty pro equities at a time when it would be very easy to be looking at cash and bonds for the first time in many years. So I think you can treat this presentation as a kind of information gathering exercise for investors who want to own equities rather than a kind of rear view mirror. We all know it's been a tough place to be an equity investor in the last couple of years, and there's a lot of column inches about that. But I think it would be really good today to kind of unpack some positives. And having had a preview of your presentation, I know there's a lot of really interesting information. So with that, just very briefly to participants, there's a Q&A box that you'll see in the bottom right-hand corner of your screen. Please do type your questions in there during the presentation. I'll be reading those whilst Steve talks, and then there'll be a chance for me to ask and for Steve to answer some of those questions at the end of the presentation. So with that, Steve, I'll hand over to you.
Well, terrific. Thank you very much, Alan. Thank you, Kepler, and appreciate everybody's time today. Like Alan said, my name is Stephen Farkas. I'm a senior strategist at BlackRock, and I work on BlackRock's income and value team within our fundamental equity division and based in New York City. So it's a pleasure to talk to all of you today. So as Alan teed things up nicely, I want to cover a variety of different topics, namely talk about the trust, the company, the team that manages this portfolio, a little bit on our philosophy and process and the portfolio and how we're positioned. But to Alan's point, spend a considerable amount of time as well on our outlook, our views on the equity markets, and really highlighting some of the really interesting opportunities that we're seeing in the equity space today. There are things that we think are particularly compelling in the equity space, and we'll get to that in just a few minutes. But I think some of the key characteristics of this portfolio, namely that the portfolio team seeks to invest in quality companies, value and dividend characteristic related companies and stocks, all while maintaining an ESG positive rating in the individual companies in the aggregate portfolio. And those are things that we see a lot of potential opportunity in. So excited to talk to everybody today. So I will reference slides for everybody's benefit, but I will not use every slide in the presentation. So I may skip around a little bit, but I'll do my best to describe things on the page. But I do apologize if I skip a few of the slides in the interest of time. So it's just a reminder, the portfolio that I represent, BlackRock Sustainable American Income Trust, is managed by BlackRock's income and value team, which is based in the United States, with the majority of our team and investors based in our New York City flagship headquarters on the west side of Manhattan. And a little bit of background on the team, because one thing I would stress is we view ourselves as one of the premier value managers within the US market, and this is a strategy that we feel very passionately about. So by way of background, the income and value team at BlackRock, we oversee approximately 60 billion in assets under management on behalf of our clients. And as the name denotes, this team primarily invests in strategies that exhibit characteristics such as value in the individual stocks that we're buying, and also the benchmarks that we tend to have are value benchmarks. For example, the Sustainable American Income Trust, you can see that the benchmark is the Russell 1000 Value Index. And in addition to that, the team generally feels very highly about, when we look at individual companies, trying to identify stocks that exhibit quality characteristics and dividend growth characteristics. And I'll talk about that more in just a few minutes. One really unique thing about our team that differentiates us from other asset managers within the US equity space is the way that we structure or build our team. We utilize what we call, or what we've deemed, a hybrid research team model approach, where some of our competitors, what they'll do is they'll have a high number of individual teams that maybe run one portfolio with only a handful of analysts. We sometimes refer to that as a boutique approach, where it can be a little bit isolated, and those analysts, they may have a lot of depth in their individual stock coverage that they're researching, but they cannot offer a lot of breadth. So that's one approach. The other is what's sometimes called a centralized research approach, where you have a pool of analysts supplying the stock research, if you will, for many, many different portfolio managers and many, many different types of individual strategies and funds. And the concern we have with that type of approach is it may offer more breadth, but it doesn't allow a lot of depth in the research. So what we utilize is a hybrid approach, where we have a team of over 20 investment professionals that are exclusively researching portfolios that exhibit those characteristics I mentioned earlier, things like value, things like quality. And in the case of the Sustainable American Income Trust, if you look at some of the key characteristics of this portfolio, you can see that this is a multi-cap, meaning it can invest in typically large or mid-capitalization companies, typically investing in the North American or US region, although we can deviate from that at the margin, and I can talk about that when I get to the portfolio construction. And the typical number of holdings in this portfolio are 30 to 60 individual stocks. And what is crucial and critical about the objectives of the trust is we actually have a dual objective for this portfolio. So we've been running this portfolio actually now for, in some way, shape, or form, for over a decade. But as of July 2021, we now have a dual objective, where first we have the objective of delivering attractive levels of income and capital appreciation over the long term. But in addition to that, the trust seeks to deliver superior ESG score and lower carbon emission intensity than the benchmark, the Russell 1000 value, and that's using the benchmark data by MSCI. So that is the dual mandate of this portfolio that is headed up by the three individuals you can see on the screen here. Tony DeSpirito is the lead portfolio manager and head of the income and value team I mentioned earlier. He's also the global CIO for all the fundamental equities at BlackRock. 30-ish years of industry experience, over 25 years, working at BlackRock now for about 10 years, previous to that at another value management firm, and a graduate of Cornell, University of Pennsylvania, and Harvard Law School. In addition to Tony, the two other PMs, David Zhao and Lisa Yang, David is a 20-plus year veteran of the industry. He's been working with Tony for 15-plus years. He's also the co-director of research for the entire income and value team. And then in addition, Lisa Yang, who's been at BlackRock now since 2017, is also another graduate of University of Pennsylvania and was at a previous firm before BlackRock, has over 10 years of experience. So this is a little bit on the team. At a high level, a bit about the objectives of the portfolio and some of the individuals that are the portfolio managers for the company, the Sustainable American Income Trust. Now, what I want to do now is spend a few moments highlighting the investment approach, what we feel is important in looking for individual companies and what we're seeking to deliver in the trust itself. Now, you can see here the investment outcomes, like I mentioned earlier, is to deliver compelling levels of income and capital appreciation and delivering alpha through fundamental research. So bottom-up, company-driven research led by our investment research team, the income and value team I mentioned earlier. But in addition to that, maintaining that higher level of ESG score relative to our benchmark using data through MSCI. And our investment approach is really centered around a few key components. One of the cornerstones of the team I mentioned earlier is this desire to find companies that exhibit quality characteristics. Generally speaking, that means things like good levels of free cash flow generation, typically low levels of debt or leverage of those companies. And one of the key characteristics very related to dividends is what we refer to as the capital allocation policy or the shareholder friendliness of individual companies. And by that, I mean, when they generate free cash flow, what are they doing with that? Are they reinvesting it into the business? Are they paying down debt? And what we're looking for is really a healthy mix of different things that they're doing with the cash. But one of the characteristics we particularly feel strongly about are companies' ability to pay a dividend and grow that dividend, hopefully over time. Why do we feel that these are strong characteristics? Well, quality companies historically tend to offer strong returns, generally speaking, in the US market. And another key characteristic of quality companies in a portfolio is they tend to offer strong historical downside protection when there is market volatility. And as Alan mentioned in the introduction, as we consider ourselves, very, positive and bullish on the historical long-term investment case for equities, right? The case is strong for owning equities in the long term to deliver long-term appreciation and income. The fact that there are periods in the economic cycle that are more volatile, potentially like the time we're in now, where we would say we're a later cycle, but we feel that owning quality companies may be beneficial because they can offer possible downside protection because they are historically a bit more resilient than lower quality companies in a potential economic slowdown. Now, I mentioned dividends. This is one of those key characteristics in how we define quality. Companies that pay distribution, but more important than just paying the distribution itself, we do the analysis and the research on the companies for potential inclusion in the portfolio. We look at the industries that they're in, and we want to feel confident in their potential ability to not just pay the dividend, but through their ongoing cash flow generation, maybe their margin structure, they're able to grow that dividend ideally through time. And the power of dividend growth is in some ways hard to overstate, because not only do you generate an income stream, but the potential for that to grow over time can do things like maintain pricing power if there is inflation. And in addition to that, it tends to reflect highly on companies. If they're able to do that, that is, in our view, historically speaking, a good reflection that they're a quality business, the ability to grow that dividend through time. That means that it's a company management team, we feel, that is using their capital allocation quite wisely, and that's important to us. Another key characteristic of our investment approach is it is about quality companies, dividend growth, but you have to do it at an attractive price. So this is a value portfolio. I mentioned we're benchmarked versus a value index. And we feel that is critical, because if you overpay for a business, for a company, they could be a terrific company or stock, but if you overpay, meaning maybe a heightened level of PE ratio or other measurement of valuation, that could be potentially a headwind to your return because you're overpaying for an equity. So we do a lot of work on our team being disciplined around making sure that we're buying those quality dividend growth companies but at attractive valuations to ideally generate the objectives I mentioned earlier of income and capital appreciation. All of this, meanwhile, while maintaining that premium ESG score for the portfolio versus MSCI. Now, I'm going to skip over all of the individual components here because I think I've alluded to a lot of this in my other remarks. But just a reminder, the ESG objective, like I said, a premium MSCI score versus the benchmark, looking at things like environmental, social, and governance scores. And there are various exclusions in this portfolio, not owning things like controversial weapons, civilian firearms, thermal coal tar sands, and tobacco stocks. With the, like I mentioned earlier, performance objective of this being a relatively high conviction, concentrated portfolio of 30 to 60 stocks to deliver that attractive level of income and capital appreciation. Okay, so I hope that served as a good introduction and explanation for the process, philosophy, and team behind the Sustainable American Income Trust. What I'd like to do now is spend a few minutes on our current positioning, and then I can speak to the outlook of the team. So here is where the portfolio stands as of the end of August of this year. A few things to point out. Well, I mentioned it a little bit earlier, but just as a reminder, in summary, a lot of our view of the current economic situation is we may be a little bit more late cycle, and as a team, we are a bit more cautious in our outlook for the short term and medium term. We're still very positive on the asset class of equities. Sometimes you'll hear Tony say things like, you want to own equities for the long term because of their really compelling ability historically to deliver really strong income and capital appreciation. But in the US right now, we are slightly cautious in our positioning. And what does that look like in the individual sectors that we're overweight and underweight? Well, one of the areas that we like quite a bit relative to our benchmark today is the healthcare space. Because, and I'll show you some really interesting slides on this in just a few moments, but healthcare tends to be very resilient. Even if the economy is slowing down, people still need their healthcare. It's one of the last things that you would want to cut your individual spending on, so it tends to be very resilient in a slower economic period. But in addition to that, it has very attractive valuations relative to other parts of the more stable parts of sectors in the US. If you compare it to things like maybe consumer staples or utilities, it's attractively priced. And there are individual fundamental themes within healthcare that we think are really interesting today. If you look at this phenomenon in the industry where there's a lot of medications that may treat obesity, there are individual companies that we're exploring where they could take advantage of that emerging very large potential trend is the drug pipeline and scope for those types of treatments is hard to overstate. Really interesting, compelling things. A few other characteristics of the fund that I want to highlight. You can see that the dividend yield on our portfolio, as I alluded to in our process and philosophy, is actually at a slight premium to our benchmark, which is the Russell 1000 value. You can see the gross dividend on the underlying stocks in this portfolio. I want to make that distinction. That is, of the underlying stocks is around 2.5%. Now, the distribution as of the last fact sheet on the company itself is 4.4% net. So I want to make sure that is clear. But the underlying dividends on this portfolio are approximately 2.5%. And what I think is really an attractive characteristic is if you look at the dividend growth rate of our portfolio, it's at about 9.1%. So the growth of those dividends is quite compelling relative to the Russell 1000 value. It's actually nearly double that. We also boast strong characteristics from a fundamental quality standpoint. You can see our return on equity is slightly higher than the Russell 1000 value at 13.2 times. And that quality you're getting at an attractive valuation, what I mentioned earlier. It's about finding key quality characteristics in good dividend growth, but making sure that you're buying them at attractive valuations. You can see the PE ratio of this portfolio is considerably lower than the value index and significantly lower than the broader US market. We're trading right now in this portfolio as of the end of August at about 12.1 times forward 1 year earnings, which is a considerable discount to the S&P 500 at 19.4 times, and still a healthy discount to the Russell 1000 value, which trades at 15.2 times. Now, there is one thing on this slide I want to point out. It's about where we're finding some select opportunities today. And that has to do with some of our non-US exposure in this portfolio, which may at the surface seem slightly counterintuitive. This is a American income trust. I'm talking to you from New York City. Why do we have non-US stocks in the portfolio? Well, in summary, the way that we do stock research, the way that we structure our team, is the analysts on our team are industry and sector experts. And it's incumbent on them when they're researching a US listed stock to do the research on some of their competitors that are listed outside of the United States. And on occasion, this is not all of the time, but sometimes they'll discover a non-US name that may have a better risk-reward potential in the individual equity. And oftentimes, and what typically is the case, is these are large multinational companies that do a lot of business in America, in the United States anyway. And if they're attractively priced, maybe relative to their US counterparts, and have similar quality characteristics, we may invest in specific non-US companies. One of the names to call out in our top 10, if you look at this slide, that fits this theme that I just mentioned, would be a name like Shell, where it trades at an attractive valuation relative to maybe some of its US counterparts, with a similar business, and it also does a lot of its business in the United States. So we can be selective about that, and we feel that that offers us a point of differentiation if we find those potential single investments outside of the US, and that's a good example is using Shell. So in summary, you can see here that we are overweight healthcare as one of our sector allocations. We are slightly overweight financials. In that space, we have a preference for the large, big money center banks that tend to have, on a relative basis, better maybe balance sheets than some of the more regional banks. You can see Citigroup is in our top 10. That's an example of that. So a small overweight to financials, and then an incremental small overweight to information technology as well. Some of the areas that were slightly underweight or underweight, you can see industrials were underweight relative to our benchmark, which is the Russell 1000 value. I mentioned that we're a later cycle, and we're conscious of some of these individual stocks in that space maybe priced too optimistically, where there's too much, we think, continued growth priced into those stocks, and we're being a bit more cautious in our investments in the industrial space. And you can also see we have a little bit of an underweight in areas like utilities and real estate, where the valuation, we would say, is not as compelling. Now, those are more stable parts of the market, maybe relative to some more cyclical sectors like industrials, but their valuations are not as compelling in our view, given their fundamentals compared to maybe something like healthcare, which we would, generally speaking, prefer to own if you look at our overweights and underweights. So hopefully that gives you a good overview of the portfolio's current positioning. I would just mention, to talk a little bit about performance briefly, you can see that the long-term performance of the strategy, we've annualized our return since October of 2012. That's the longer historical performance since the inception of the portfolio. We've annualized about 10.8%. And since the strategy change, we've annualized about 5% returns, which is slightly challenged versus our benchmark. One interesting phenomenon that's happened, particularly in the last 9 months, which has been a headwind to our performance, is you may have heard the term the Magnificent Seven in the US market, where there's a handful of stocks, a lot of them related to the AI theme, that are driving the performance of the stock market, and they're really standing out in terms of their leadership from a performance standpoint. One of those names, which is Meta, or Facebook, it was in our benchmark, performed well, and we didn't own it because it's not a dividend stock, and it didn't meet our criteria for ownership in this portfolio. And not owning Meta was actually a bit of a headwind to our performance in the period, maybe measured in the year-to-date period or the last 1 year or so, and that has been a little bit of a drag on our performance. But as Alan mentioned, we feel very strongly about the case for equities right now, and I'll show you some specific slides to really, we think, make the case for owning quality, value, ESG-related companies at this point in the cycle today. So why don't I transition to the last part of my presentation, talking a little bit about the outlook of the team and some of the things that we're excited about and some things that we're a little bit more cautious about. So maybe starting on the left-hand side, if I'm looking at the slide directly, we are slightly more cautious on some of the macroeconomic conditions we're seeing today. while it is encouraging that inflation in the US is softening, it is still elevated. And there are core items within measuring inflation, things like wages, that remain sticky. So what does that mean? It means that, well, first of all, we are in this unprecedented tightening of monetary policy, and the combination of inflation still running higher than average and a period where we've been more hawkish in our monetary policy gives us a little bit of caution that maybe we're later cycle, because ultimately the tightening of monetary conditions in the US, fiscal conditions in the US, means that it could mean slower growth potentially. And combining that with the need for the Fed to get inflation under control, we think that they're maybe trying to apply the brakes more to the economic conditions in the US rather than hit the accelerator and the gas. And that gives us a little bit of caution. And because of those things, if you see the next bullet, we would say that the odds or the probability of a recession relative to sort of normalized history currently in the US is a bit elevated because of this tightening cycle that we're in today and this constant debate of whether or not the Fed will be able to achieve that soft landing, and maybe will it be maybe a mild recession or just a mild slowdown. We're a bit cautious on that. And all of these things take time to play out in the US market. You know, we've seen studies that show that economic growth doesn't tend to slow down until maybe 18 to 24 months after the Fed starts its tightening cycle. And it's a little bit of that wait and see from the team's perspective, because we're still only about 18 months, maybe a little bit longer, into the beginning of that tightening cycle we've seen from the Fed. So a little bit more cautious in the medium term, but more positively, we are seeing very strong stock-specific opportunities in the marketplace today, because the S&P 500, the broad US market, is relative to its own history trading at a premium, but there's a lot of dispersion in the individual stocks within the US market. Some are very expensive relative to their own history or relative to the market, and others are trading at material discounts. And we feel because of that dispersion in the market, it gives a really good opportunity for active management and the ability to potentially generate alpha. So if you talk to Tony and the team, and what we talk about a lot is, if you think about the opportunity in stocks today, slightly more cautious for the short and medium term, as we're a little bit later cycle, but equities for the long run, historically, they're one of the asset classes that really do provide really compelling returns. And the opportunity today for finding individual companies, amongst the broader US market, we think is really interesting because of the large dispersion you're seeing in the US that could create the opportunity for active management. So I'm going to, in the interest of time, skip a few slides, but I did want to show you one really exciting thing about where we're in the cycle today to really make a compelling argument for value and quality stocks. We looked at data going back to 1978, looking at post-recession or post-slowdown periods in the United States. And what did the stock market do after that slowdown period? You can see that the average return of the Russell 1000, so the measurement of the broad US market, is about 34% over the next 3 years. But what's interesting is value stocks tend to lead after an economic slowdown on the 1 year following that period, the 2 year following that period, and also the 3 year after that period. So if we do see an inflection point where growth picks up after maybe a little bit of slowdown, historically speaking, value is a very attractive place to be. And in addition to that, as we're in this rate hiking cycle, we did an analysis of looking at quality stock characteristics after the Fed stops raising interest rates. We could debate whether maybe there's 1 or 2 more hikes in the US or what that exact number is, but we feel that we're closer to the end of the rate hiking cycle than the beginning. And in those periods, with data going back to the 1980s, owning quality stocks with some of the characteristics I mentioned earlier, they tend to outperform not just bonds, but the broader equity market on the 1 year, the 2 year, and the 3 year period following the end of an interest rate hiking cycle. So for us, again, while we are slightly cautious on the overall market, we think that there's a lot of opportunity for value type investing, quality investing with a portfolio like the Sustainable American Income Trust based on some of the historical context of what we've looked at. So Alan, I know I'm coming up right at half an hour. I have a few more slides that I could show, or I could maybe turn it over to you to see if we'd like to take some questions.
What was your plan for the next couple of slides, Steve? Because they may answer some of the questions. So,
well, I could show a few slides on maybe some sectors and get into a little bit more detail on why we like, for example, healthcare. But I'm happy to start with some Q&A.
Why don't we? There's one question about how to buy the shares, so we mustn't forget that one. Obviously, I'll come back to that in a minute. There's a question about, have you given up any returns because of ESG? And I think what you're saying is that you can see the bench is actually generating slightly better returns. So is it fair to say the trust hasn't surrendered any returns to decisions purely made on an ESG basis?
Yeah, I think a few things come to mind. I mean, we like I just mentioned, compelling management teams that look at the risks of ESG and believe in being a leader in their space. Over the long term, we think that will be potentially additive to the returns. But there are going to be periods, really with any actively managed portfolio, where they may be challenged with their performance relative to their benchmark. And I would really encourage people to not take a relatively short period of time, in the grand scheme of equity investment, and sort of draw that out as the conclusion into perpetuity for one type of investment approach. I think it's been a relatively short period of time. And as you mentioned, Alan, energy has had a really compelling run, for example, generally speaking, in that period. Actually, I would say relative to other ESG or sustainable strategies, because we're more value oriented, I think you can see our energy exposure is actually higher than the S&P 500. So in a lot of measurements, we've actually hung in there a lot better than maybe some of our peers. But yeah, I think I would urge people to not use a relatively short period of time to write something off.
Yeah. You on another topic, you mentioned you alluded to quality companies, strong balance sheets, and interest rates go up, but of course, interest rates going up doesn't hit companies straight away. If they have 5-year bonds, then it takes time for those high rates to actually be expressed in profits, doesn't it, or lack of. So are you starting to see now a kind of divergence in there's you start with a divergence of opinion. These are too geared, they're going to, and you must be reaching a point now where you can actually see that divergence in earnings of companies that you don't own compared to quality companies. Is that kind of establishing itself as a trend now?
Yeah, and a key point you made there, Alan, is that it does take a little bit of time to work its way through the system. So when rates go up, it's going to take a little bit of time before companies are going to have to refinance their debt at higher levels. And what's interesting is, in this earnings period, which we're currently in today, we're starting to see some cracks in the armor from some of the companies that are now having to come back to the market and refinance. I won't go into specifics, but they are starting to happen. And I think that is in some ways related to the chart that I pointed out earlier. You can see on the right-hand side, for quality companies, which maybe are less geared, have less leverage. And I think part of the reason that they have outperformed over that 1, 2, and 3 year period after the Fed starts hiking is partially because of what you just mentioned. And what's interesting is the most outperformance you can see, this is cumulative, but like the 3 year period, I think is related to, I think, the point you're trying to bring up, which is sometimes this takes a little bit of time to work its way through the system.
Yeah.
And when that happens, I think that not having a lot of leverage and gearing on a balance sheet will be probably, we think, rewarded relative to the ones that are going to struggle more from a financial leverage standpoint.
Yeah. And the I mean, it's quality growth and value, and as you've shown the kind of historical pattern of those styles or characteristics outperforming in the aftermath. Are you seeing some of the kind of traditional signals for value like M&A starting to pick up?
We are. So one of the things that we pay a lot of attention to when it comes to opportunity value is looking at the historical levels of value in core indices in the US. And if you look at the S&P 500, for example, and you measured the percentage of it in value stocks and the percentage of it in what would be measured or considered growth stocks, today, the allocation in growth stocks is really approaching the levels that we saw in the tech bubble in the US. So from a sort of mean reversion standpoint, historically, the last two times that this has happened, and actually it happened the other way right around the global financial crisis, the index was skewed the other way, where the S&P actually had a higher value percentage. And whenever one of these styles gets sort of out of whack or out of sync with its long-term history, it no longer is historically, no longer a tailwind. It actually becomes a headwind as you fight that mean reversion. And like I mentioned, we're seeing that right now today. And the last time that this happened, the other style materially outperformed. And that was the 15-year period starting in around 2005, with growth doing better than value. M&A, we are seeing that. I mean, it's a bit more isolated. There have been some pockets of M&A, particularly in the energy space. I'm hesitant to say that that is a net conclusion that in and of itself is a positive sign for value, but we are seeing a little bit of a pickup there. I think one of the things that we think is positive for value is just the economic regime that we're in today is very different than the last 10 years, where a very different Fed policy and higher interest rates, which actually are more like long-term historical average interest rates. The last 10 years have been very, very good for long duration equities. In other words, growth stocks, where you're buying growth into the future. Your discount rates are zero because interest rates are really low. That period is over, we think. And this new regime that we're in, the higher cost of capital, buying companies that are, maybe the cash flows are more closer to today than 10, 20, 30 years from now. Generally, we think that that is more of a tailwind for value investing where we are today.
If you have time, just a couple more questions. Can you just talk a bit about the healthcare allocation? There's a question. I won't go into the specific stocks, but it looks like you may have had some turnover in that part of the portfolio. Obviously, healthcare has had some ups and downs recently. And so what's the kind of outlook for healthcare from the portfolio managers?
Certainly. So the outlook for healthcare is just as this is a very large part of the U.S. market, and it is very it is not homogeneous in terms of the different stocks that you can invest in healthcare. And we are seeing some pockets within specific industries within healthcare that we think are really, really compelling. Now, at the broad sector level, you can see that healthcare tends to be the most resilient sector on a relative basis in a growth slowdown, with data going back to the 1980s. So in that sort of later cycle playbook, tends to be historically a good place to be investing in for the reasons I mentioned earlier. People are hesitant to cut their healthcare spend even in tougher times, and also demographics really play into this theme continuing. It trades at a good valuation relative to the S&P. We would say actually with better fundamental characteristics within utilities that are slightly cheaper and maybe even better than consumer staples at a better discount. And one thing that I want to sort of highlight is there are areas of healthcare that are under a little bit more pressure. And I think this is the benefit of being an active manager, is doing the research on this. Interestingly, within the U.S. healthcare space, U.S. pharma space, there are some stocks out there and companies that face very large patent cliffs, where they have on-patent drugs in the US that are going to be going away maybe in the next 5 years or so. And the future potential impact to their earnings is quite large. And what we've done in our portfolios is lean into maybe some of the non-US. I mentioned that we can selectively buy non-US companies. Some of the non-US European pharmaceutical names actually have much healthier patent expiration life cycles than the US counterparts. So we think that that is potentially something that could be additive. And actually, if you look at the returns of some of the US names this year, they've been very weak, down considerably. In some of the names in our portfolio, I mentioned the theme of what are called GLP-1s, the obesity treatment type individual companies. Now, those stocks have done quite well. So we like that within pharma. So be selective in healthcare, and we've leaned into those areas.
Yeah. The biggest company involved in that has a market capitalization larger than the country it's based in. So I'm sure everyone on this call knows the name of that company. Then what keeps you awake at night? What's the biggest risk to this? I mean, your outlook is actually pretty. Yeah, your outlook is pretty realistic, isn't it? But what's the biggest risk to a different scenario coming about?
Well, when I get questions like this, I always think sort of relative and then in absolute terms. I think on a relative basis, because we are a value strategy that focuses on ESG and dividend growth, if there was, somehow a period, we saw like the first half of this year, where the market once again was narrowly led by a handful of growth stocks, that may be a headwind for the relative performance of a strategy, maybe versus something like the S&P 500, or that can be a challenging period for what we do in this portfolio. So that's something that is a little bit of a potential issue, but it's not really, in our view, like our base case. We didn't talk too much about AI, but it seems like some of the extreme euphoria around that is maybe a little bit more behind us than in front of us. We could be wrong on that. But I think, to your point, what keeps us up a little bit more at night is the very difficult situation the Fed is in, where there may be, for example, political pressure for them to start reducing rates in order to juice up the economy, in an upcoming election year. While on the surface that may be good for growth, that double dip scenario may lead to, and when I say double dip, I mean a reversion back to higher levels of inflation would lead us right back to where we started from an inflation standpoint, where we're going to have to just cut rates even more aggressively in the future. And that's similar to what happened in the 70s. But one other thing that keeps a lot of the investors up at night at BlackRock is we are just keeping a pretty close eye on the deficit in the US and the amount of debt that we're issuing. Actually, a lot of investors would say that's actually quite bullish for equities, because with things like buybacks, actually the equity universe is shrinking. So from a supply demand standpoint, there's very little equity issuance out there, but there's a healthy amount of buybacks. Actually, the sort of size of the addressable equity market is getting smaller every day. And guess what's happening to the debt markets? It's going up in the US, for example, by trillions of dollars a month. Now, that may be good for equities, but it does keep people up at night when you think about the stability of the dollar and what that means for inflation in the US. So something that a lot of the senior investors at BlackRock are keeping a pretty close eye on.
Steve, thanks so much for your time. Ending on a positive note and answering a couple of the other questions, there is a helpful section on the Trust's homepage entitled "How to Invest" to answer that question. We obviously can't go into details about that, but the information you need is there. And the slides and the recording of this presentation will be on Kepler's website shortly, so you can get a hold of the deck and drill a bit more into some of the statistics that Steve's been talking about around valuations and inflection points and other exciting things. So, Steve, really appreciate your time. Obviously, I think scrolling through the attendee list, there's some familiar names, and you know how to get in touch with us if anything else occurs to you afterwards. We can route questions to BlackRock. Thanks so much for your time, Steve, and thanks to everyone for attending.
Thank you, Alan. Thank you, everyone, for attending. We appreciate your partnership.